Hey guys, welcome back to another video. If you're new to my channel, hi, my name is Miranda and I teach about anything and everything related to the trucking industry and how to navigate it. So if this is a topic that interests you, feel free to subscribe down below. Well guys, this will be the first part of a multi-part series focusing on what might happen in 2023 in the trucking industry. In this particular video, we're going to be exploring what might affect the spot rates as we go into the new year. Now, just as a note, this video will be a little bit different. We are unfortunately not going to the board today. And that's because some of you have said that you cannot see the charts too clearly on the board, especially if you're watching on your phone. And I think that these charts are extremely important to understanding this video today. So instead, I will be showing all the charts on the screen so that everyone can see. Anyway, let's jump in. Ready? Let's go! So to start things off, I want to, of course, focus on supply and demand if we're talking about the future of spot rates. Now, just as a refresher, supply refers to how many dispatchable trucks and drivers are currently in the market ready to be dispatched. Demand refers to how many loads are in need of transportation at any given moment. If there are more dispatchable trucks than there are loads, of course the rates will start to go down. If there are more loads available than dispatchable trucks, the rates will start to go up. So let's start by looking at the supply portion, and we're going to be looking at this chart right here, which is by Sonar. And what this chart shows you is the total counts of fleets authorized for hire. So as you can see, there are two lines here. There's the blue line, which is the total amount of fleets authorized for hire. And then down below, you will see the green line, which is the new fleets, the new entrants authorized for hire. So from this chart alone, you might start to freak out because what you will see is that it seems like that number is growing month over month. It doesn't look like capacity is leaving. It looks like more and more carriers are getting their authorities. But before you freak out, what I want to let you know is this chart shows us only active US DOT numbers, right? And US DOT numbers are really easy to get. They're free and they don't need to be activated. So this does not give us a clear picture of who is actually in the market. It just shows us that there are a lot of people with an active US DOT number. Are they using it or are they not? We don't know. But now it's time to make you freak out a bit. So take a look at this chart right here, also by Sonar. And this is the total count of interstate for hire fleets. And interstate means that these fleets actually have to have an active MC number. Now, MC numbers require a ton of investments. You have to invest in insurance, BOC3, UCR, IFTA, IRP, and all of those things. And those things are not cheap. So this chart gives us a better view of how many people are actually invested in this industry, how many people actually spent money. And as of August, at least, we can see that the number of interstate fleets is continuing to grow, unfortunately. And what does that mean? Well, that means that the capacity in the market still continues to increase and the market is getting oversaturated. Maybe. But again, this is not all, because even though these fleets right here that you see on this chart are authorized for hire, meaning they invested into their MC number, fleets can consist of one or more trucks. And what we need to know is how many actual trucks are there in the market right now. Well, here we have another chart, which is the total count of tractors from interstate fleets of all sizes. And well, go figure. What you can see is that fleet sizes are continuing to increase, at least as of August. Unfortunately, this chart has not been updated in a little while, so I can't show you the numbers for right now. But what it does look like is that fleet sizes are expanding. The question is, how is this possible? How are fleets expanding in a market like today? Well, there are a few things at play here. First of all, carriers are desperate for new equipment because of the supply chain issues caused by COVID when it hit. According to ACT, in October of 2021, the wait for a new truck was almost 15 months. And as you guys can imagine, fleets want to replace their old equipment in order to save on those maintenance costs that keep eating away at the bottom line. Now, what usually happens? Well, usually the larger fleets, they go ahead and order the new trucks, and the smaller carriers are the ones that go into the used truck market. And because of the boom in 2021, all those new carriers, the small carriers who entered the market, actually the 195,000 new carriers who entered between July 2020 until May 2022, according to FreightWaves, all of these new guys turned to the used truck market to get their equipment ASAP in order to catch this amazing wave of hot rates. So what does that do? Well, again, supply and demand is at play. All of a sudden, there is a huge demand for these used trucks. So what do you think happens? Well, the prices of these used trucks start to go up. Here's a chart from Sonar showing how the prices of a 3-year-old truck has changed over time. And you can see that in April of 2022, it peaked to the point where 3-year-old equipment was going for almost $150,000 a pop, which is insane. So what happens when the used truck market is so hot? Again, according to FreightWaves, what happened was many truckers sold off their equipment in order to make some money. And now they're trying to build back their fleets. So let's go back to this chart right here. What we have to understand is capacity is probably not leaving the market, at least not as quickly as it should be. What is happening, though, is probably smaller carriers and owner-operators who are shutting their doors because they cannot survive in these turbulent times. They're shutting their doors and then looking for jobs with bigger carriers. Now, let me show you a visual so you can understand properly. So here we have 15 single truck carriers who shut down their doors. They cannot handle the instability of the market. The prices of fuel are too high, so they just cannot handle it at this point. These are carriers who decided to sell off their equipment because of the constant downturn of the market. While there are going to be a few that decide to completely leave this industry because it has disappointed them so much, a good majority of them will start looking for jobs with larger carriers so that they no longer have to worry about the day-to-day grueling tasks of actually running the business. So this means that these larger carriers are getting more trucks to house these unfortunately bankrupt owner-operators. So what does this mean? Well, if this theory is correct, then this means that capacity hasn't really decreased. The amount of dispatchable drivers has not really decreased. Only the amount of actual carriers or active authorities has. But for us, it doesn't matter how many active authorities there are. We only care about how many drivers are ready to take a load right now, because supply and demand. So what does this mean for 2023? Well, it means that while some capacity will leave because some people are so fed up with this industry that they're deciding to leave it completely, a good majority of smaller carriers and owner-operators are simply moving themselves to a different truck with a different carrier, therefore not really decreasing the capacity by much in the general market. We're just moving pieces around here, if that makes sense. So now that we have come up with the prediction that while capacity will decrease, it will only be slightly, we have to now look at the demand portion of the equation. What we're all hoping for is that there are going to be so many loads that they're going to overwhelm any capacity available on the market, thereby increasing spot rates. But in order to understand the potential future of transportation demand, we have to look at a bunch of things, starting with macroeconomic indicators. First, there is the GDP, or the gross domestic product. Now, what is it? This is the total market value of goods and services produced in the US in this case, in a specific period of time. And it provides a good economic snapshot and whether the economy is growing and by how much. So I'm not going to get into all the boring details of how the GDP is calculated, but what you need to be aware of is the things that go into the calculation of the GDP, and that is number one, consumption or consumer spending, number two, government spending, there's the investments, and then finally it's net exports. So there are a few problems with looking at the general GDP when trying to predict the freight market. Number one is consumption or consumer spending. Now, consumption makes up about 70% of the total GDP. But the problem is that almost 70% of the consumer spending is spent on services, aka things that don't go on a truck. Another issue with the GDP is the net exports part. Basically, net exports excludes all imported goods. And this is not good for us because imported goods are very important to our industry. After all, who is transporting all of those imported goods all over the US? Trucks. So let's break down the GDP into parts. So we already know that 70% of the GDP relies on consumer spending, and that is a huge chunk. But we need to know how much are consumers spending on goods, not services. We want to know how much people are spending on things that can be transported by a truck. Now, this is a chart that I got from Fred Economics data, and it shows what consumers are spending on goods, and I have it from Q3 2019 all the way to Q2 2022. Unfortunately, there is no newer data here, but it will give us an idea to make a prediction. As you can see right here, there was a jump in consumer spending on goods at the middle of 2022. And this is because of lockdowns and people were doing everything to keep themselves from going insane. And what better way to tend to mental health than shopping? Then the consumer spending peaked summer right here in Q2 of 2021. And since then, it has slowly been going down. At first, the consumer spending started going down because as the country was reopening, people were spending on things that they have not enjoyed in almost a year. And that's services and entertainment, movies, restaurants, travel, basically things that do not go on a truck. So that, of course, had an effect on our industry. And in 2022, with the rising fuel costs and the inflation that was ridiculous, of course, people started keeping their money safe in their pockets because they were not sure what is going to happen next. Now, we can see from this chart that the trend is a downward trend for consumer spending. And what does this mean for us? Well, it means that if this downward trend continues, we are not going to have that much freight to move. After all, the less people are buying, the less factories are manufacturing, and therefore the less there is for us to transport. But what about sentiment? How do you as consumers feel about the economy, or at least the future of the economy? Well, here's a chart from Statista showing the consumer sentiment. And what you will see is that the consumer sentiment dropped in November from October. But thankfully, it increased slightly in December. Why would you care about this? Well, because the more positive the outlook of consumers, the more likely they are to start cashing out. And if they're cashing out on goods, that means we get to transport everything related to making and delivering those goods, aka more volume for us. Now, according to this chart, at the moment, it looks like we're heading in the right direction with consumer sentiment. People are a little bit more positive than they were last month, but this is most likely due to the gains in the stock market. Now, of course, I like to dig, so I found this chart right here by Trading Economics that gives a forecast of what consumer sentiment will look like in the coming few quarters. And as you can see, unfortunately, we see Q4 of 2022 is at 59.1, which is great. But then it will have a sharp drop in Q1 of 2023 and will then plateau throughout Q2 and Q3 of next year. And of course, as consumer confidence drops, so does their spending, and therefore, we are going to have a little bit less to transport. Now, here's another chart by Sonar, and I thought that this was important to show you. This chart shows you how many loans or leases are past 30 days due or more, and it gives us insight into the financial health of the US consumer. Now, we can see that there is a sharp increase in delinquencies in the past few months. Of course, it's nothing compared to what it looked like in the past few years, but still, it gives us some insight. And what insight does it give us? Well, from this chart, we can comfortably predict that people are struggling right now. They're not going to be cashing out on a ton of goods that they don't need. Instead, they're going to be focusing on the essentials and covering their debts. And again, if consumers are not spending much on products, that means we will have less freight to transport. Now, I know that looking at this consumer spending and consumer sentiment is a little bit discouraging because the data shows us that 2023 will be just more of the same crap storm we're facing in 2022. But now let's take a look at the other portion of the formula, which is imports. These are important for us in our industry. So let's take a look. Global trade is an essential part of our industry because raw materials that are produced in one part of the world can be processed in a second country, assembled in a third country, and then consumed in a fourth. And between all those stages, there is transportation, whether it's by air, by sea, by rail, or by truck. Now, as you guys know, US companies have profited immensely from access to China's market, and China is actually the third largest export market for the US behind Canada and Mexico. So to make my story a little bit more concise and short, imports can predict spot market rates. Why? Well, as I said before, whatever is imported into the US has to then be transported within the US, and who transports it? We do. To top it off, you have to understand that if businesses are ordering and importing goods from China, that means that they're also manufacturing more goods here. The more imports, the more manufacturing, the more goods are moving all over the US. In other words, more imports signals more demand. So let's take a look at this chart right here. Again, of course, by sonar. The blue line signals the imports from China from the beginning of 2022 until now. The green lines are the spot market rates from 2022 until now. So what you will see really quickly is that spot market rates and import levels are following the same pattern. And what you can see from December is that import levels are down and so are spot market rates. So what it signals is as imports continue to decline, spot markets will also continue to decline. So now a little piece of news to help you understand what might happen in 2023, or at least in the beginning of the year. Currently, the US manufacturing orders in China are down 40%, which is horrible. Because of this sharp drop in demand, Worldwide Logistics predicts that China will shut down their factories 2 weeks earlier than usual for the Chinese lunar year. So what does that mean? Well, the prediction is very simple. If you think imports are low right now, imports will drop even further in January and February. And I predict that January and February will be the true bloodbath in this industry. The spot rates will continue to decline through the end of February, actually end of March in my opinion. And with capacity not leaving quickly enough, yeah, it's not going to be a fun time. Now, I know this has been a lot for you guys. I know this video is ridiculously long, but before I end this video, I want to look at past trends in order to predict future ones. I think it's extremely important. And of course, the biggest trend in the trucking industry is seasonality. Now, I'm talking about volumes here, not spot rates. Volumes will show us how much freight usually gets shipped at a particular point in time. And usually, the more volume, the better the spot rates. Of course, as long as capacity or truck capacity is not exceeding the volume. So here we have a chart by Sonar again, and this shows us the volume of freight shipped out from 2008 all the way to 2022. So what you're going to see right away is the peaks and valleys that follow pretty much the same pattern year over year. Of course, in 2009, there was a little bit of a breakdown of this pattern. Not a little bit, a lot, but this is because of the financial crisis of 2009. And of course, in April of 2020, you will see a huge dip, and this is because of the COVID shutdowns. But in general, the market follows a similar pattern year over year, and this should put your mind at ease a little bit. Another thing you will notice is that volumes have gradually increased in the past few years, which is great. So let's go through this. Do you see these dips right here? Well, these are all from January of each year. It's a very clear pattern that every January volumes will dip. This means that in January of 2023, be prepared for even less freight on the market. Now, let me tell you a funny story here. I started in this industry in 2019, and January of 2020 was my first January in the trucking industry. Now, when I logged into my load board somewhere in the beginning stages of January in 2020, I saw that there are no loads there. So I was so confused that I actually called the DAT and I asked them if their load board is under maintenance because I don't see many loads on my side. And of course, the guy started cracking up and he is like, ma'am, it's January. Volumes are down. It's an embarrassing story, but it's true. I was shocked at how volumes dip in January. So be prepared. January and February will be the quiet season again in 2023. Now, what you will also see is these peaks right here, and these happen in June of every single year. Freight volumes will historically start picking up at the end of March and will peak in June because of the produce season. So I think that 2023 will follow a similar pattern. Again, my biggest fear at this point is January and February of 2023, because even in the best of markets, January and February is so quiet that this is a time where no one really makes much money. In a turbulent time like right now, it can be a killer. But I do believe that things will start picking up slowly towards April of 2023. Now, when I say things will start picking up, I'm talking about freight volumes. I'm not sure about what rates will do. That depends on whether January and February of 2023 pushes out enough capacity in order to have a less saturated market by April of 2023. Only time will tell. Anyway, guys, I think that's enough for this video. Again, I'll be making a few more of these focusing on different aspects of 2023, including fuel, truck prices, trailer prices, and so on. But for now, I hope that you learned something new for yourself and that you start preparing for the potential likely headwinds of 2023, at least in the beginning. Be safe, stay healthy, and I'll see you guys in the next video.